Are you looking for high dividend stocks? If yes, you are at the right place. In this video, we will have a look at companies yielding more than 6% in dividends. I'm in Investing Pro, my software to analyze stock. If you are interested in subscribing, you can find the link in the comments below. For this screener, pretty simple screener, we will have a look at companies with a market cap above 20 billion US dollar, a net debt over EBITDA less than 3 times to avoid risky companies with too much debt, and a dividend yield greater than or equal to 6%. With this, in the US, we have 5 companies. To analyze these companies, we will have a look at the industry the company is operating in, the market cap, revenue growth over 5 years, valuation multiples. So we have EV over EBITDA, PE ratio, and price to free cash flow ratio on the 12 last months. We won't have a look at the price over tangible book value because we don't have financial companies here. And there are no discounts over tangible book value. Neither we will have a look at PE ratio because we don't have growth company in this list. We will have a look at return on invested capital, which is I would say ratio measuring the effectiveness of the company on its operations. We won't have a look at return on equity because it's more for financial companies and it can be biased by debt. So I prefer having a look at return on invested capital. We will have a look at debt with net debt over EBITDA and net debt over equity. And finally, we will check the dividend yield and I will say the security of this dividend based on the amount it represents in free cash flow. The free cash flow payout ratio, effectively. Let's start with the first company on the list. It's Altria. Altria is a global leader in tobacco. It's around $100 billion market cap, so it's a large cap. No growth. It's 0% growth over the 5 last years. Organic growth is decreasing. They are from time to time trying to buy other companies, but globally the growth is flat. Valuation multiple, they are quite more reasonable, I would say. 9 in VE over EBITDA, 11 in PE, or 11 in price to free cash flow. It's, I would say, a reasonable valuation. We don't have the metrics for return on invested capital, but you can see the video I already did for Altria on the channel. Return on capital is pretty high because Altria is actively buying its outstanding shares to cancel them. So it improves it reduces the invested capital. So return on invested capital is pretty high. And of course, Altria has a moat because to operate in this industry, in this highly regulated industry, you need a license from the authorities. So they have this license and it's their moat. Debt over EBITDA is pretty manageable, I would say, around 2 times. And we don't have the value for net debt over equity, but it's again, it's biased because the equity is reduced. It's decreasing year over year because the company is actively purchasing shares to cancel them. Dividend yield, we have 7.2% in dividend yield. It's, I would say, interesting at this stage, and it's well covered by the free cash flow because it's only 75% of the free cash flow. So all in all, I think it's interesting. It's not really expensive. Profitability is good. Debt is under control. dividend yield is interesting, and on top of that, you have we have share buybacks, improving the growth of your dividend per share year over year. So, in my opinion, Altria is something you should have a look at if you are interested in high dividend stocks. Next one on the list, it's by Pfizer. We are with a pharmaceutical company. So they had boom years during the pandemic. Now it's severely crashed, I would say. Growth decelerated, and they need to find new molecules, new products to deploy on the markets to foster growth. For now, it's quite slow, but improving. $142 billion in terms of market cap, so pretty large cap. 9% growth, compounded annual growth over the last 5 years. So pretty high growth, but on the last year, it's I think it's pretty flat. Market is normalizing for Pfizer. Regarding the valuation multiples for pharmaceutical company, I think it's a bit low, but pharmaceutical companies are not always richly valued. So for Pfizer, we are at 8 times EV over EBITDA, 15 in terms of PE ratio, and 14 in terms of price over free cash flow. So it's not too expensive, I would say. Around 10 in return on invested capital. Okay, profitability, I would say. Net debt over EBITDA is around 2 times, so it's manageable. 50% of equity, so debt is under control, and we have a dividend yield of 6.9%. So it's covered by the free cash flow, but it's quite the payout ratio is quite high. We are at 1994%. So there is no room to increase the dividend if the free cash flow doesn't improve, unfortunately. So let's see if they are able to increase the free cash flow. In my opinion, they will be able to do so. In worst case, they will have to take cash from their treasury to pay the dividend. I think at this level, it's a bit high, but manageable. So let's see for the next year if the payout ratio is at this level. But I think it will improve. So in my opinion, Pfizer also is a good option to put in your dividend portfolio. Next one, we have UPS. UPS is a leader in the freight and logistics. We have the company has a 85 billion market cap, 4.2 revenue growth over the last 5 years, 9 times EV over EBITDA, 16 in terms of PE ratio, and 20 in terms of price over free cash flow. Okay, valuation is reasonable. It's not value, but it's not that expensive. So I think it's fine. 14 in return on invested capital, so pretty okay, I think, in terms of profitability. There is a big difference with the return on equity compared to return on invested capital. Maybe the company has a bit of debt, so it could help, but maybe they have also financial other stake in other companies, something that improve the financial results, because the difference is pretty big here. 1.6 debt over EBITDA, 141% for debt over equity. It's a bit high, but I think they are purchasing shares, so the equity is actually decreasing. So we need to assess if this ratio is high. In terms of debt net over EBITDA, in my opinion, it's totally fine. 6.5% dividend yield, interesting, but it's not well covered by the free cash flow. So if you want to have a look at this stock, this company, you need to assess if the free cash flow is structurally lower than earnings. or just punctually. And free cash flow could be impacted by two things. Either you have a defavorable change in working capital, so a positive change, or you have an increased capital expenditure. If it's capital expenditure, it's okay. If it addresses future growth. Actually, obviously, if there is no growth, then capex is wasted. Regarding working capital, it's in any case it's not really good. If you have a positive change, it means either your clients are paying later and later, or you have stocks. So I don't think the company has stocks, inventory, I would say. And or you can have also your suppliers paying you, asking for you to pay sooner and sooner. So you need to check that. But currently, with this free cash flow, the dividend is not well covered. So this one is pretty not secured, I would say. So that's why for UPS, if you're interested in this stock, maybe put it in watch list and wait for free cash flow to improve before making a decision. Next company is Kraft Heinz. We are in the food production industry. The company is planning to do a split next year. So keep in mind that you will end up with two companies if you buy this one and hold the company for the next year. We have 29 billion market cap. So it's I would say large cap, but a small large cap, if I can say that. 1% revenue growth over the last 5 years, annualized. It's not that big. So I think they are operating in a declining market, and they are obviously the competition is huge on this market, especially with Amazon. So I think this company is managed in a declining market, meaning they are decreasing assets and return cash to the shareholders. I think it's a good decision. Gain in valuation multiple, 8x EV over EBITDA, negative earnings, unfortunately, but price to free cash flow at 8x. So this one is impacted by non-cash expenses, in my opinion. So the other multiples are pretty okay in terms of, I think it's reasonably valued. We have 5.6 return on invested capital. It's not that great. With that, I think Kraft doesn't earn its cost of capital, so it destroys value. The equation for value creation is ROIC minus WACC. WACC is weighted average cost of capital. If this difference is negative, you are destroying value. I think the cost of capital is maybe something like 9x for Kraft Heinz. Okay, it's non-discretionary consumption staples. So maybe the cost of equity is maybe 8x. There is also the cost of debt. So the cost of debt might be something like 5%. So you take the average, and you have a weighted average cost of capital maybe of 7.5%. So with this ROIC, I think Kraft is destroying value. 2.9 net debt over EBITDA. It's a big leverage, but regarding debt net over equity, it's only 44%. So yeah, it's mostly, I think it's because the EBITDA is decreasing, because maybe they are in a low of the cycle, and maybe it will improve next. So nothing to be worried about, in my opinion. 6.5 dividend yield, interesting, and we have a payout ratio of 52%. So what can we think about Kraft Heinz? In my opinion, it's not a bad option for dividend. They are returning cash to the shareholders because they know there is no growth. Profitability is not that great, but with the split they will perform, in my opinion, the spin-off they will do, it will improve the profitability. And if you have two companies, you can eventually optionally you can sell the less profitable of the two companies. So not to buy the idea, not the best one, I think. And we'll finish this screener with Verizon. Verizon is a large player of the telecommunication market in the US. We have 172 billion market cap. Revenue growth is small, really small. Zero growth, I think, over the last 5 years. Valuation is low. We have 7 times EV over EBITDA, 9 in terms of PE, and 8 in terms of price over free cash flow. So pretty cheap. Return on invested capital, it's around 9%, I think. At this level, they earn their weighted average cost of capital, but not very much over that. Not much over this, but they are marginally creating value, I would say. 3 times EBITDA in terms of net debt. It's manageable for telecom company, and it's the same regarding net debt over equity. Since telecom companies are utilities, they have a big visibility over their cash flow. They can have debt at low cost provided by banks. So you can have 5 times net debt over EBITDA for telecom companies. So in my opinion, it's fine at this level. 6.9% dividend yield, interesting, and we have 54% in terms of payout ratio. So this dividend is safe. In my opinion, if we select the top 3 in this selection, the first one would be Altria. In my opinion, it's the dividend is secured and they have a wide moat, so no problem. Even if it's a mature market or declining market, they have I think you have around 10 years of secured dividend with this company, so it's fine. And they are trying to increase the dividend. Number 2 would be Verizon. Pretty stable company. Profitability is okay. The dividend yield is okay at this level with and it's well covered. So good opportunity. And the last one would be, I think it would be Pfizer, because compared to Kraft, they are more profitable. Dividend is not that well secured, but I think it's because the free cash flow are cyclically low, but it will improve. And I think for next year, this payout ratio will decrease, and it will be fine. 3 ideas for your dividend portfolio. I hope you found this video useful, and if it's the case, subscribe to the channel, and I see you in the next video. Bye bye.